Morning friends, hope you're all well. So today we'll continue with the discussion on hire purchase. We'll try to solve a problem involving a computation of interest when the cash price and the installments are given to you. Okay, so let's get into the problem. Happy Valley Florist Limited acquired a delivery van on hire purchase on 14X1 from Ganesh Enterprises. The terms were as follows. Hire purchase price is 1,80,000, down payment is 30,000, first installment 50,000, second installment is 50,000, third installment is 30,000, fourth installment is 20,000. Cash price is 1,50,000. You are required to calculate total interest and interest included in each installment. Now if you carefully note, the hire purchase price is given to you, which is 1,80,000. The cash price is also given to you, which is 1,50,000, which means the difference between the hire purchase price and the cash price is going to be the interest part. So the total interest is 30,000. So that's the first requirement. You are required to calculate the total interest. So the total interest is 30,000. But the challenge is the second part. How to determine the interest which is included in each installment. All the earlier problems, the rate of interest was given to you, 10% per annum. Right? Some data was given to you, but in this case, there is no information on the rate of interest, which means you need to find out the rate of interest. Okay, so let's start. Step 1, obviously we can actually find out the total interest. Look at this. Hire purchase price is how much? 1,80,000. Cash price is 1,50,000. So obviously total interest is 30,000. Now the challenge is to find out what is the calculation of IRR, right? That's step 2. So what we will do, we'll try to use two discount rates. One is at 6%, other is at 12%, right? One is 6%, other is 12%. So why are we using 6% and 12%? It's a trial and error method, right? So we use two arbitrary discount rates first, and then we'll try to find out what is the difference between the numbers. Now, if you look at this second column, these cash flows are already given to us, right? 30,000 is the down payment, 50, 50, 30, 20 are the first installment, second installment, third installment, fourth installment numbers. So what I do, I try to discount, right, the cash flows at 6%. So that gives me column number 4, which is present value, which is 30,000 into 1, 50,000 into 0.94, 50,000 into 0.89. Likewise, I get 162,500. Now the question is, how did I get 0.94, 0.89, 0.84? It's simple. When I say present value numbers, it's very simple. You have to say 1 divided by 1.06. You'll get 0.943396226. So I'm just rounding it off to 2 decimals. You may use 3 decimals also. It's fine. Similarly, same 0.94 divided by 1.06, you land up at 0.89. So you need to work out like that. Similarly here, 1 divided by 1.12, you'll have 0.89285743. We are rounding it off to 2 decimals, which is 0.89. So we will discount the cash flows using two discount rates, one at 6%, other at 12%, which will give us the present value. Once we get the present value, we do summation of that, you will find that the present value when discounting at 6% is 162,500 and the present value when discounting at 12% is 148,600. Okay. Now, what is IRR rate? The rate which when used in discounting the cash flows, it will be very close to 1,50,000. Right? The cash flows are already given to you in column number 2, 30, 50, 50, 30, 20. If I discount the cash flows at that IRR rate, the sum total has to be 1,50,000. Right? But currently at 6%, the cash flows are 162,500, whereas at 12%, the cash flows are 148,600. But our objective is to reach 1,50,000. So this gives us a range. Definitely we can be sure that the discount rate is between 11 and 11.5. The reason is at 12% we are very close to 150. It's actually 148,600, which means that if I could reduce the discount rate by a small margin, this 148,600 will move up to 1,50,000. So, but what level I need to move, right? So definitely we can conclude that the discount rate is in the range of 11 and 11.5. But to be very exact, we try to use a technique called interpolation in step number 3, and we try to determine what is the discount rate. So if I use that formula, this is the formula. So 6% is the base rate plus NPV of the base rate. What is net present value? Net present value. Present value is 162,500. When I say net present value, it is 162,500 minus 1,50,000, which is the cash price of the asset. So that difference divided by the difference of the present value. What is the present value difference? The difference between 162,500 and 148,600. So this is the formula for interpolation. So I start with the base rate of 6% plus. When I use the base rate, the first numerator has to be net present value of the base rate, which is 162,500 minus 1,50,000 divided by the difference of the present value, which is 162,500 minus 1,48,600 into difference of the discount rates. What is the difference between 12% and 6%? 6%. So if you use that formula, you will land up at 11.39%, which is the interest rate. Make sense? Okay. So I repeat, step number 1 is to determine the total interest, because they have given you the HP price, they are given the cash price. So the difference between the high purchase price and the cash price gives you total interest, right? Second step is the calculation of IRR. Since you do not know the interest included in each installment, you need to arrive at a discount rate, which when used to discount the cash flows, we equate the cash price of the asset. So we use two other discount rates, 6% and 12%. We tried to discount it and we found the present value of those cash flows, and using those we get a range, and we decided that okay, the discount rate or the IRR rate will be in the range of 11 to 11.5, and which we use the interpolation formula, we got 11.39. Now having obtained the interest rate implicit on the lease, the next step is to calculate the actual interest. So we use the very same format which we used earlier. What is the cash price of the asset? That's the principal at the beginning of the year, which is 1,50,000. Okay, so once that is there, what is the down payment we have made? 30,000. So the principal at the end of the year is 1,20,000. Okay, so that's year 0. When you get the asset, the cash price is 1,50,000, but we have made a down payment of 30, which means the principal at the beginning on day 0 is 1,20,000. We need to pay 1,20,000 with interest. End of year 1, interest first accrues. So how did I find 13,668? It is 1,20,000 into 11.39%. You get 13,668. If I add these two, I get 133,668. Okay, but what is the installment? 50,000 again. Now you get 83,668. So that becomes the opening balance. Again, on 83,668, you compute 11.39%, you get 9,530, 93,198. Again, you pay another 50,000, right? Okay, so third installment is again 30,000. And then finally, you have to pay 20,000. Right, so these numbers are given to you. The ones which are highlighted in yellow are the ones which are already given to us in the problem. And 11.39 is the data which we actually found out from step number 3. Now, if you look at the total interest, it's 30,182. Small rounding of difference is always there. We determined that the total interest is 30,000, right? The difference between 1,80,000 and 1,50,000, but we can round it off and say it's around. So this is the individual interest included in each of the installments. So first year it's 13,668, second year is 9,530, third year is 4,920, fourth year is 2,064. There's a small rounding of difference of 182 rupees, which we can definitely adjust and we can close it off. Okay. So this is how you compute the interest when the cash price is given, when the HP price is given, but when the rate of interest is not given, you have to find out the interest rate by using the IRR technique. Okay. So hope this was useful.